Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Carol Massar and Tim Stenovec from Bloomberg Radio.
The price of Bitcoin. We're always watching that. President-elect Donald Trump's pick of a crypto proponent to be the next head of the SEC lifted Bitcoin to $100,000 for the first time as traders warmed to the prospect of relaxed regulations. We got with us stacy-marie Ishmael, managing editor for crypto at Bloomberg News. Stacy-Marie joins us here in the Bloomberg Interactive Broker studio. Zeke Faux is a Bloomberg News financial investigations reporter. He's also the author of Number Go Up, Inside Crypto's Wild Rise and Staggering Fall. Zeke joins us from New York as well. Stacy-Marie, there are those moments when it comes to news events that are kind of indelible in people's minds. You know, you talk to people when they heard about the assassination of JFK, or more recently in our lifetimes, COVID.
Yep.
You know, where were you when you heard Tom Hanks had COVID and the NBA was shutting down the season?
Austin, Texas.
Is Bitcoin, were you there for South by Southwest?
No, I was there for work.
Okay, you were there for work. Okay. Is this one of those moments where it's that significant when it comes to the history of cryptocurrency? Where were you when Bitcoin hit 100K?
I will say that was very much the vibe of folks in and around Bitcoin and crypto yesterday, particularly on social media, whether it was LinkedIn or X or Blue Sky. Folks who are CEOs, folks who are developers, folks who are just retail traders were like, it's here, we've made it, our time is now.
Zeke, I want to bring you into the conversation because something I've been asking a lot of people about is sort of the frothiness, because once you get to 100,000, a lot of people want to start talking about technicals, about resistance, but I mean, where do you find resistance from there? And what I'm wondering too is when you have people like the Hawk-Tua girl, Haley Welch, that are kind of jumping in and trying to launch these type of meme coins, are we actually at the phase here where things are looking a little too frothy for the crypto space?
Well, what the Bitcoin proponents would say is that all the attention that Bitcoin is getting around the price hitting this milestone, like the coverage, us talking about it right now, is part of the momentum that's going to drive it even higher. And this crypto executive, Dan Held, I once heard him explain it in a pretty interesting way. He called it number go up technology. And he said, it's a very powerful piece of technology. It's the price. As the price goes higher, more people become aware of it and buy it in anticipation of the price continuing to climb. Now, I don't think that that is a sustainable state of affairs, but that's what's been driving Bitcoin higher now. It's up fivefold since its lows after FTX collapsed back in November 2022. It's pretty wild to see how far it's come.
It is wild. Stacy-Marie, I want to bring you back in here. The reason I asked about where you were, because my phone blew up, as I think everybody else's did, with notifications about this. I was talking to somebody who works in real estate development, who has an MBA, who understands cash flows, and is extremely skeptical about why Bitcoin is worth $100,000. There are still many of those skeptics out there.
I think there are more people who don't know and don't care than there are skeptics, and then there are the true believers. That's sort of the segmentation. What I would say is, in addition to the very common market dynamic that Zeke just described about people being attracted to large numbers, and especially numbers that seem to be on a positive trajectory, there is the reality that there is something of an institutional price floor in the market now for Bitcoin, and that is the participation of the enormous asset managers, the BlackRocks of the world, who are getting more involved in things like ETFs, the people who want to put Bitcoin into people's 401ks and have that kind of institutionalization of how retail investors are getting access to this asset. And that is driving some amounts of the enthusiasm. But the other is the possibility that the US federal government might itself become a large holder of Bitcoin.
Well, let's dig into that a little bit. Why? You're talking about a potential strategic Bitcoin reserve, or maybe other methods of the U.S. buying this during the next administration. What's the justification for that? How do you get that past taxpayers?
How you get it past taxpayers is a question for political scientists, but the justification that's being offered by the administration is that Bitcoin the US should be the world capital of financial innovation, and Bitcoin and blockchain technology are key elements of that, right? That's the claim. And Zeke was there in Nashville when President-elect Trump was kind of making these claims to a large gathering of people who are absolutely primed to believe it. The problem for, I think, the average taxpayer, to your point, is joining the dots between this is a virtual currency, a digital currency. It's not something that you can hold. It's not like a vaccine or wheat or petroleum that in a time of crisis you have exactly a clear sense of how this will be used. But for folks who believe in Bitcoin and folks who believe in blockchain, they're like, just getting that assurance from the US government is enough.
Zeke, I want to bring you back into this conversation so you can talk more about when you have a new administration coming in here, and then sort of the lack of regulation when it comes to the crypto space. How do you view, and your sources view, kind of the direction of Bitcoin and other cryptocurrencies with the Trump administration coming in again?
Well, it's kind of funny that Bitcoiners are so concerned with regulation. I mean, in most ways, Bitcoin was already legal and wasn't facing huge threats from whatever administration was going to come. I think the Bitcoiners are really excited to have the president talking about Bitcoin and talking about the possibility of this strategic reserve, even if it is kind of far-fetched. Trump truthed today on Truth Social. Congratulations, Bitcoiners. You're welcome. And what he's saying is that, I mean, he flew to Nashville. He gave a speech at the Bitcoin conference where he laid out how he was going to do things to help promote Bitcoin. He said that, the US, if Bitcoin's going to the moon, the US is going to lead the way. Mm-hmm. And now, without even doing anything, just with his election and with what he's been saying, he's gotten kind of the Bitcoin mania going to like new heights. And it should be said that Bitcoin executives came together to give Trump $25 million in campaign donations, which helped smooth the way for him to flip from calling Bitcoin a scam, which is what he said during his first administration.
So, stacy-marie, how do you view sort of the flip-flopping there? Because when you think of even, say, an Elon Musk with EV makers and things like that, they definitely benefited, and his company benefited more so under a Biden administration. But we were thinking about the crypto side of things and maybe the AI side of things. How is this sort of shift coming in your kind of view?
I mean, I think one of the big things, Zeke is entirely correct. Bitcoin itself wasn't targeted by the U.S. Securities and Exchange Commission in any real way, but pretty much every other part of the market was, right? If you were somebody who was doing transactions in Ether on the Ethereum blockchain, if you were somebody who was doing crypto lending, if you were somebody who was lending to somebody who was doing crypto lending, the SEC probably found a way to sue you, or at least to tell you to stop doing that thing. And the widespread expectation, especially among the folks who were celebrating on social media yesterday, is that it'll be a totally different ballgame under the new regulatory regime. Okay, so that's exactly where I want to go right now. And I brought this up in a live Q&A that we did on the Bloomberg terminal and for Bloomberg subscribers a little earlier today about Bitcoin hitting 100,000. Zeke, I want to send this on over to you first and then have stacy-marie weigh in. And it's just the whole idea behind regulations. We live in a world with regulations and with laws, and those laws and regulations, a lot of people would argue, are there for a reason. I'm wondering to what extent you think the guardrails will be off an industry like cryptocurrency during the Trump administration, and if at all we could see negative repercussions for that. I mean, we're just 2 years out from the collapse of FTX, and a lot of folks who lost quite a lot of money. Some of it has been recovered at this point with different projects, but there were folks who were hurting for quite a bit of time in the wake of that.
Yeah, I mean, I was just watching an old interview with Paul Atkins, who's tabbed to be the next SEC commissioner, and he was saying that he felt some of the huge frauds that occurred during the last crypto boom, like FTX, were the result of the SEC not creating a set of crypto-specific regulations that would bring the industry inside them. And instead, since it was difficult to comply, people were just sort of running wild. I'm not sure how true that is. And we mentioned Haktua coin today. Yeah, this is they've actually been a huge number of these meme coins where basically somebody with some degree of notoriety starts promoting some made-up coin. People jump in hoping that the price will pump and that they'll get out while the getting is good. And then inevitably it's like a zero-sum game, or actually worse, most of the people who do it are going to lose money. Now, where that fits in like a pro-crypto regulatory regime, I'm not sure, but it doesn't seem like the kind of economic activity we should be encouraging.
Stacy-Marie, I want to give you the last word here, 30 seconds on this. Thinking about a regulatory environment where guardrails could be off.
I think one of the most important things to that point you're making, Zeke, and what you said in the conversation earlier, is what does this mean for a person who buys something that they think is real from somebody they think is reliable that turns out to be a scam, a fraud, misrepresented, missold? What is the recourse that they have? And a lot of the industry's focus has been on the regulation of the companies, the exchanges, the technology itself. And there's a large gap, particularly in the US, for consumer protections as it relates to that. And I am personally very interested in seeing whether we'll get any movement there.
We'll definitely appreciate you both of us joining us. Stacy-Marie Ishmael, Managing Editor for Crypto at Bloomberg News. Also Zeke Faux, Bloomberg News Financial Investigations reporter, also the author of Number Go Up, Inside Crypto's Wild Rise and Staggering Fall.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
We got all eyes on what's going on when it comes to tariffs and the potential threat of tariffs from the incoming administration. Our Bloomberg intelligence team actually out with a new note this morning about the risks of tariffs, specifically on U.S. automakers. U.S. automakers could see more than $3,500 in added labor costs per vehicle if President-elect Donald Trump's proposed tariffs are imposed on imports from Canada and Mexico. And the figure may also rise if auto parts are reshored. This is according to a Bloomberg intelligence analysis. Ford, GM, and Stellantis might bear the biggest brunt given their production in Mexico, but Tesla could be least affected. We got with us Lynlee Brown, partner in global trade at Ernst Young. She joins us from San Francisco this afternoon. Lynlee, first of all, how are you out in California right now?
Good. It's hard to complain.
Great.
December in California.
Okay, good. Just wanted to check there. Hey, I do want to get an idea from you, first of all, how you think about the relationship between tax and tariffs, because this is the intersection of your specialty at EY, and specifically the conversations that you're having right now with leaders at companies all around the country as they prepare for the incoming administration.
Yeah, that's a great question. It's been very busy, and this is certainly the topic du jour. With the current threat of widespread tariffs, companies are really examining multiple avenues of mitigation, and one of those levers, one of those super powerful mitigating factors is customs valuation. Pertinent to customs valuation is tax, particularly where you have buyers and sellers in these global transactions who are related. Namely, the automakers, the companies that you named in kind of the intro, this is them, right? This is that valuation of products. That is all tax.
And Tim was actually just mentioning a really interesting stat from Bloomberg Intelligence where they were compiling data about how Detroit automakers face a $3,500 a car hike on Trump tariffs, potentially an added labor cost per vehicle. What I'm wondering, when you have a situation like this, what are the potential here of this getting passed down to consumers and shoppers of these types of vehicles?
Yeah, that's a great question. The importer of record will bear that duty cost 100% of the time, right? Then to your point, right, the question is, will that product, from a price elasticity perspective, will they be able to pass that on to consumers or not, right? If you are the only seller of a very particular product, you can charge whatever you want to. If you're not, and there's, a lot of competition, those companies are probably going to absorb those costs. And that's when comes in these mitigating activities, right? How do you mitigate the extent of those tariffs so that it doesn't, because those go right into cost of goods sold, but the ability to pass those costs on to consumers will totally depend on the availability of, and the competitiveness in this market.
What do you mean by that? Do you mean geographic competitiveness and companies that might not necessarily be imported? Like how does that work? Because you would imagine that every company is sort of dealing with the same thing, at least if they're manufacturing products in those areas.
Yeah, so we've certainly seen a shift, right? So from 2018 with like the first Trump administration until now, companies have certainly diversified their supply chain. They moved out of China. They moved to, nearshoring, right? They moved to Mexico. Certain other companies, moved other places from a supply and demand perspective. The impact of the tariffs is on those automakers that sort of went all in from a Mexico perspective. They're in that bullseye right now. It's totally geographical. It depends on, nearshoring, farshoring, whatever decisions you made to diversify your manufacturing base. That will certainly impact what options you have available to mitigate the tariffs and just how impacted you are.
So walk us through how exactly tax and customs departments will end up having to work together on this.
Yeah, it is really, it's interesting because, within EY, I sit in the tax group, right? I'm in indirect tax. That's kind of an EY construct. Within most companies, and certainly it will vary based on sector and based on product, customs could sit in supply chain. It could sit in legal. It could sit in tax. Automotive, for example, historics tell us it sits in tax. Technology sits in tax. Where that doesn't happen, right? What these companies are going to need to do and have already started doing is connecting those dots to say, if I really want to decrease my duties on imported products, most duties are ad valorem. They're a percentage of customs value. To the extent you decrease your customs value, you pay less duties. The only way you're really decreasing that value is to team with tax, particularly in these areas of related party pricing. So where you are purchasing from a related party, you have a lot more ability and kind of, you have the ability to kind of change where is the profit in that value chain. That is a tax discussion with a customs valuation lens. Those rules are different. OECD transfer pricing, WTO customs valuation rules, but they have the same goal, right? Arm's length pricing. So those two groups will undoubtedly work together. They have been largely since 2018. And for any of those linkages that were broken, they will certainly pick that right back up. And that is the way that both customs and tax kind of team together to create the most strategic value to enterprises when they're in this immediate kind of blizzard of tariff discussions.
Lynlee, really appreciate you joining us. Lynlee Brown, partner in global trade at Ernst Young, joining us this afternoon on the latest when it comes to how executives, how boardrooms are thinking about the added labor costs or the added costs associated with Trump's tariffs. Again, we don't know what's going to happen on January 20th. We only know what the president-elect has said thus far, Jess.
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Well, you can find our next guest products in the dairy section of your local supermarket. Lifeway, known for its kefir. It's that yogurt-like drink. You can also find it in my cousin's fridge, I found out over the weekend. I opened the fridge and there was some Lifeway in there. It's a publicly traded company, about $360 million market cap. We got back with us Julie Smolyansky. She's second generation of her family to run the company after her father started it and took it public on the NASDAQ. There's a pretty cool story behind that. Julie Smolyansky is chairman, president, and CEO over at Lifeway, joining us from Los Angeles. Julie, great to have you back with us.
Actually in Miami now. I'm
Miami.
at Art Basel.
Oh, look at that. Okay. Well, trade one warm climate for another warm climate.
Right. Warmer than here, for
sure. Love it. Hey, so since we last spoke in October, Lifeway rejected that unsolicited takeover offer by Danone North America, $27 per share, because according to you guys, it, quote, substantially undervalues the company, though you also said that the board is not opposed to the sale of the company at any price. What's the price?
Well, that's for others to decide. But what I can tell you is that, I'm not surprised that there is this interest and a lot of eyes on us. We have achieved 20 quarters of year-over-year growth. The last 5 quarters were historic, record-breaking quarters. Our gross profit has gone up almost 100% in the last 5 years. Our shareholder return, we've delivered a 1,200% return in the last 5 years. So there is a lot going on at Lifeway, and we're really excited about all the opportunities that are available. So, we still have a long runway to go, and we have a playbook on how to do it with an incredible management team, and really on trend products that are really hitting the tipping point. Like, we haven't even scratched the surface of all the opportunities around gut health, microbiome, friendly live bacteria that is beneficial to the body, that science is now finally just catching up to what my ancestors have been saying for 2,000 years, which is that kefir and Lifeway kefir is beneficial to the body. And so we're really excited about all of that.
Julie, do you want to actually sell this company? Because you grew up with this company. You took over at the age of 27. Yeah. It's a really interesting story. It's also a tragic story about why you ended up taking it over. But I imagine there's a lot of emotions with this. I mean, do you want to sell it?
I mean, there's a board, there's an advisor. Evercore has been brought in to be the financial advisor, investment banker. We have a very acclaimed legal team. So, what I want is not necessarily really relevant, but what I can tell you is that Lifeway and kefir is in my DNA. And like you said, my father started the company. It originated from the Caucasus Mountains, where my family is from. And, there is certainly a long legacy and authenticity that is priceless. And, that will never disappear. Our legacy, our history, what we've brought to the food industry, to the dairy case. We really, my father brought kefir to America and created the category, commercialized it. So, what I would say is that there's probably no one else that knows kefir better than I do. I was 11 years old when my dad gave me the very, very first batch of kefir that he made in our basement outside of Chicago in Skokie, Illinois. And I was 11 years old when I went to the first trade show and grew up on a trade show floor. 11 years old when I, took part in my very first in-store demo, teaching Americans what kefir is all about. So, that's what I can tell you, is that it's in my DNA. So I'm very passionate about it, and that will never change.
Well, I wanted to follow up on that, because why do you think it's not relevant if you're chairman and CEO of the company?
Well, there's a board, and there's, a lot of other factors that go into play. So that, that's really, there's corporate governance, and we're a publicly traded company, and the board is going to do what's in the best interest of all shareholders and all stakeholders. So that's what's really important to us, to make sure that we follow a great process and bring the best value to shareholders. But we're committed to bringing shareholders the best value for their investment, and that's what we'll keep doing.
What message do you have for shareholders right now who want to make sure you're not distracted with these takeover offers and the work that goes into these, versus making sure you're staying focused on delivering products and also working on that pipeline of products?
For sure. Well, we just announced a series of new innovations that we've been working on. We just launched 10 new exciting lactose-free kefir flavors and really exciting trend-setting flavors like pink passion fruit, pink dragon fruit that was inspired by the Starbucks success of their pink drink, pistachio rose vanilla inspired by the viral hit of Dubai chocolate bars. So a whole bunch of really hot flavors, taro ube. So those are hitting the streets. It's really exciting to see them out in the wild. We just announced another new innovation, a collagen kefir smoothie. There is a huge demand for skin healthy foods, foods that make us glow from the inside out and bring beauty to everyone inside out. We really believe that beauty comes from within, and it starts with the gut. And there's incredible science and research that shows that the microbiome is just starting to become, all the good things about it is just starting to become known to lay people. And so we're focused on sharing that message with as many people as possible. I'm right now at Art Basel, doing the art of business at a founder-made summit, talking with other entrepreneurs about all the great work that we're doing, incorporating AI into our business, how it expedites our product launches, et cetera. So, I'm definitely very focused on all the great things that we have. We are excited to announce our children's product, ProBugs, which is the first kefir in a pouch, first product in a pouch. We really disrupted the baby food space by bringing pouches to the market and disrupting that whole space. But our ProBugs are, for the first time, we're scaling into mass market. They've always been available at Whole Foods nationwide exclusively, but now we're taking them mass market based on some research that shows that this is a continuing demand for parents and kids, and we're making sure that all of our consumers from cradle to grave are being served in one way or another. We'll be announcing new expansion of our farmer's cheese, which has become really a huge success. It's been a legacy product for us for the last 38 years, but farmer's cheese is really taking off because of the viral nature of cottage cheese, because of TikTok and social media. Cottage cheese really took off last year, and our farmer's cheese is already basically like a better version of blended cottage cheese. So we have like a recipe hack there. So, farmer's cheese is going into mass market for the first time into 1,400 stores in January. So we have a lot of great things that we've been working on and are hitting the streets, and that's what we're dedicated and focused to. And the board will handle the other stuff in the boardroom.
And we were talking about sort of the farmer's cheese, cottage cheese, and things like that. Who do you consider to be your prime competitors?
Well, it's hard to say because, Lifeway is really the 95% category leader in kefir, for example. So we're the global category leader. We have 95% market share in the United States. We're the #1 category leader in Mexico, where we launch and export to. We're in South Africa now. We're throughout the Caribbean. We just announced a new distribution deal to UAE and Dubai. That'll be shipping in the next couple of days or weeks. And so it's hard to say who's our competitor. We're the #1 in kefir. We're the #1 in farmer's cheese. I would say, the next thing would be other kinds of categories that compete with us, but not specifically anything within our category. We're the #1 in both of those with no competition behind us.
Julie, we're going to have to leave it there, but it's always great when you join us, whether you're in Miami for Art Basel or you're in LA. Julie Smolyansky, Chairman, President, and CEO over at Lifeway, joining us this afternoon.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close
That funky music will drive us till the dawn.
on Bloomberg Radio.
With less than 20 minutes to go before the closing bell, the S&P 500 is just marginally lower down about 0.1%, Tim, but still on track to snap 4 consecutive sessions of gains. Of course, Tim was pointing out earlier how the S&P 500 has hit 56 records so far this year through yesterday. So one of the best years we've seen so far this century. Now it's time for Drive to the Close with
this century. I mean, we're like a quarter of the way through the century.
I mean, that's right. We're going into 2025. Yeah, if you put into historical context, 2021 saw, I think it was around 70 all-time high. So that was that year where we saw a lot of the meme craze and Doge craze as well. And markets had peaked out later that year in the NASDAQ 100. But one of the best years, 1995, also had more than 70 records. But still, nonetheless, 56 is good here. But we want to bring in Eric Clark, portfolio manager at Rational Dynamic Brands Funds from San Diego, who is going to break down the outlook for markets in 2025. It's great having you join with us, Eric. And I want you to just discuss as we're kind of the calendar flipping going into 2025? I mean, we still have a little under a month to go here. So what is your kind of take as far as positioning going into year end? And what does the positioning say as far as how investors are moving things around and shifting things in their portfolios going into 2025?
Yeah, hi. Happy holidays almost. It feels a little like November of 2021 right now with the speculation, and that's what happens when people are nervous and there's a lot of uncertainty with the election and the results. And, the Fed's been gating off the economy for 2.5 years. So when that all changes, some animal spirits get unleashed. And I think that's where we are right now. So that always makes me a little bit nervous short term. But I think, heading into 2025, we should have a good, stable economy with an administration that's clearly more pro-business and less regulation, hopefully maybe even working on the government and their operating efficiency. So, we see lots of positive things. And, the consumer is still strong in spending, albeit not broadly, but that isn't a new phenomenon. The consumer's been very value-oriented and trade-down-oriented for the last, 2 or 3 years because of inflation. So we don't really see that changing too much. We just worry a little bit that the speculative part of the market is getting a little too excited for people. And so, we don't tend to play in that world anyway.
Is it like Bitcoin, speculative?
I would say Bitcoin. I would say lower quality stocks, smaller cap stocks without profits. Those things have lagged for the last year. And so they're playing a little bit of catch up, and some of the big cap, high quality names are slowing down a little bit, which is fine. They were, doing all the heavy lifting for most of the year. So,
well, okay. So let's talk a little bit about what you're going to do and how you might make some changes in that fund. HSUTX, the Rational Dynamic Brands Fund, year to date up more than 31%. It puts it in the 87th percentile of its peers. So certainly some significant outperformance there. Over the last month, up close to 10%. Amazon, Apollo, KKR, LVMH, Netflix, Chipotle, among the top holdings in there. How does that change? How are you changing the portfolio, or are you sticking to what you have in there right now?
Well, we're sticking to some of the things like, Amazon's been the biggest holding for a couple of years now, and we got a chance to really make it much bigger in 22 when the stock was down 60% or so, which we thought was really silly. So we got a chance to buy a bunch of names when the market just didn't care about fundamentals in 2022. What I would say is we're introducing a little bit of defensiveness to the portfolio through things like, Clorox. We already have Walmart, which tends to be a pretty good defensive, even though they're playing offense pretty good these days too in retail. We've added, NextEra Energy, which is a utility in renewables. And then we have some contrarian ideas for 2025 we've added Disney, we've added Nike back. We haven't had that one in a while. We've added Starbucks back. We haven't had that one in a while. But we still love, the private equity guys, even though, maybe those stocks might be a little bit ahead of fundamentals. Long term, they're still going to all grow their assets, by double over the next 5 years. So the stock prices certainly will catch up to the fundamentals soon enough. So generally speaking, keeping with the same themes of consumer spending and the big trends that are happening, but always looking for some catch-up opportunities that haven't moved, that aren't so expensive, that people don't really love, or that may be, real turnaround stories. And we're seeing more and more in the retail sector for sure. So
you like Apple, Netflix, Amazon. What about when you come to chip stocks like NVIDIA and maybe some of the other smaller ones?
We obviously sold NVIDIA way too early, and we had some good gains on it. But to me, if I were going to play in the semiconductor world, Taiwan Semi still looks more interesting to us, much more reasonably valued, has to be a part of every conversation within semiconductors and manufacturing. But, as a consumer dedicated investor, the technology that we own tends to be more consumer tech rather than, semiconductors in general. So that tends not to be a place that we play. We love Salesforce. Clearly, they are going to enable lots of consumer companies to, implement AI initiatives streamline operations, get some operational efficiencies. That's going to be a major theme across corporate America for the next 3 years. And, my view is that once you implement those things, your stock might not look as expensive as it does if you can reset margins higher and profits higher because you're just doing things much better and delighting customers and allowed to raise your prices like Meta did, with their ads. So AI is definitely a very important thing. It's not just semiconductors. It's going to ripple through the entire, all of corporate America.
In the last 30 seconds that we have with you, what are you staying away from? Apart from the speculative stuff. Sorry.
Sure. I mean, I think it's if you are high valuations, super high expectations, and going into the year where your business is probably about as good as it gets, then those are areas that I would like to stay away from, because I'm much more focused on where are estimate revisions, where have they bottomed, and where are the beats probably more likely, rather than in the most heated part of the market that everybody wants. I tend to be I use the phrase looking for diamonds in a dumpster, and that's what we're doing in retail right now.
Hey, Eric, always good to check in with you from sunny San Diego. Eric Clark, portfolio manager over at the Rational Dynamic Brands Fund, joining us this afternoon.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.